Got it. All right. What is up, everybody? So I am super stoked. I got Tavi here. He is calling in. You're in Denver, you said?
Yes, I'm in Denver. Thanks for having me, by the way.
Perfect. Yeah, absolutely. It's an absolute pleasure to have you on. I have a chance to go through your Twitter a little bit as I do and stalk people. And you have a lot of really interesting perspectives, especially as it comes to kind of like a just macro market discussions and some of the other things that we were just kind of doing a preamble to, some of the precious metals topics and things like that. So I'm looking forward to diving into those with you for sure. But first off, welcome to the channel.
Thank you. Yep.
Second off, I would love to start with just a little bit of your background. So I saw that you're from what, Sao Paulo?
Yes, I was born and raised in Brazil. Lived in the state of São Paulo for until my age of 20, I guess 19. Then I moved to the US to play tennis in college. And then the rest is history. I guess I've been here for some time now.
Yeah, man. So did you do jiu-jitsu while you were there?
No, believe it or not, I am
Oh,
probably the only Brazilian who doesn't know how to do jujitsu or play soccer very well. So,
what?
yeah.
Yeah, so I train a lot at Victory MMA down here in San Diego. I'm in San Diego, and the grappling coach there is Dean Lister, who spent a lot of time in Brazil. So he talks about, just growing up there and whatnot. So I had to ask, but all right, maybe we can convert you into jiu-jitsu. I'm hopeful.
I would love to.
Dude, it's so fun. It's physical chess is what it comes down to. Right now, I'm like 235 pounds. Like I'm
Wow.
mediocrely strong, but I've never felt like such just a wuss compared to like some of these 160-pound dudes that are just so well versed. That's why I love jiu-jitsu, because you could be strong, but it's very, very mental.
Well, I am a
Um,
huge fan of MMA and UFC. I'm not gonna lie. So
you're
that's
already there.
yeah.
You're
I
there.
just
That's
cannot do
perfect.
anything on in terms of that, but certainly watch it a lot.
Yeah, well, good. Jiu-jitsu is a perfect entrance into that. There's no like face punching and stuff, so it's a gentle intro.
I
Um,
need that.
yeah, exactly. So you came to the U.S. Was it the U.S. for college? You said.
Yes, so I moved to Liberty University in Virginia. I was recruited to play tennis in college. I played tennis, started playing tennis when I was 14, and then when I was 18 or 19, I was started to move or look for universities in the U.S. I knew there was ways of getting scholarships here to play sports and then perhaps get education in a cheaper way than in Brazil, and also
Yeah.
learn English and so forth. And I always loved the American culture, and so it was a very easy move when it comes to that. And I fell in love with it, and I'm still here.
Yeah, that's awesome. So talk to me about how you got kind of started in the finance space.
Um, it's tough to pinpoint exactly when it all started, but I think I've always seen money as a not so much as a glorious way of showing off people, but more as a security and safety feature of my life. Given the fact that
Mm,
when I was 13 or 14, maybe 14, my dad had his own business. He was very successful. He did very well, especially in the 90s and early 2000s, and then things turned south. And when
mm,
things turned south, whereas I was a teenager, and it was very difficult to see everything, just literally going from everything to nothing. And so for me, I've
got it.
always helped him in many different ways of being very dynamically involved in his business, along with my parents and my mom as well. And so the entire family had to really get together to go through that pain of a downturn economically and financially. And so after that, I think I've always been fascinated by financial markets, and I think in college was really when I started to read a lot about finance and read a lot about the economy. And then I started investing my own money, and lost some money, and that was part of a lot of experience in that period,
Mhm.
and started to move forward. And really, I mean, I remember. back in college, I had very good grades, and I was studying for business administration, but I was really not too focused on college as much as focused on learning about finance, and I loved it. I mean, I just think the strategy side of it is one of the most fascinating things of this industry, and figuring out the markets is going to be an endless learning curve that I think. I mean, I wake up every day extremely fortunate for the job that I have, and always happy to be part of this. But then, let's see. I think in when I moved to Colorado after college, I actually met Kevin in a tennis court. Kevin is the CIO and founder of Crescat Capital. After working in finance and other uh, as an intern in other places, I really started working with him and got most of his principles when it comes to approach of investing and learning about quant models, which he always used a lot of his proprietary quant models in order to run or really manage capital. And so I began to learn from him and started to apply the same principles in macro. And so that is when I started to really add value to I think to Crescat. And this was kind of the beginning of me going from an analyst to a portfolio manager, and then starting sharing some of my research to the rest of the world. And so lot of things, a lot of turns in that. I'm just telling you the very short story, but that has been a lot that happened in that period. But now after what 11 years maybe, I've been with Kevin now working pretty good relationship with him, and now Quentin Haney as well. So the company has grown. The fund is now we're managing somewhere close to $300 million of capital today. So a lot of things have changed since the beginning. I mean, we went from a 50 million, AUM to a 300 million AUM in the course of 3 to 4 years. So things have gone a lot of big changes in my life, and I think in the whole company's. Since the beginning of it, I think we've done a lot of changes, and so very happy and very proud of it. And now as a partner, now my goal is to continue to grow here and make this one of the best macro shops in the world. And that's the whole goal.
That's awesome, man. Um, so I want to talk to you a little bit about Crescat, but before that, you said something that really, really resonated with me because it was, I don't know, just a perspective that I've never really thought much about. And you were talking about that you had, your dad was very successful in business, and the economic downturn, is really where you all went through like this adjustment period. And I'm just personally curious about that because I find like most of my circle that I know, most of us came from almost an inverse where we started like I had a single mom who was working two jobs trying to keep the lights on essentially. So we kind of started from not quite the bottom, it's not that bad, but definitely a more impoverished state. I am just very, very interested to understand just, I don't know, what that transition was like for you all when your dad had this really successful business and then the out external forces, right, the market at large started to negatively impact that. You were talking about some of those adjustments and whatnot. I'm just really curious, like your thoughts about that time period and how that has fueled the rest of your trajectory in the finance space. I know you said it got you interested, but just again from a personal perspective, curious about that cycle in your life.
Well, I think, first off, a wealthy or emerging and wealthy family in Brazil would be considered perhaps in international standards more of a middle class, especially in the US. But
Okay.
I'm not sure what is worse. What's worse is if it's you starting from zero or starting from something and then going to zero when you were 14, 15. I think I
Yeah.
haven't done the other side of it, so I'm not sure. But that was painful for the age and not being really knowing how to behave in such a setup when you're
Mm.
a teenager. But for me, I think there were a lot of lessons that happened back then. Number one is the lesson of leveraging up when when you're against a secular trend. So basically, what my dad, I think, was a lot of lessons, and one of the mistakes was he started with a retail business that was doing very well, and, and then basically we started to see Chinese products being imported to Brazil or
Mm,
exported to Brazil, reducing his margins.
got
He
it.
didn't see that coming. He thought this was going to be kind of a short term trend. It
Right.
ended up being a secular trend. That was the beginning of it, and so it completely took him out of business because he couldn't compete with them. And at a time when he was leveraging up in the sense of opening multiple stores all over Brazil.
Got
And
it.
at the beginning, he was killing it. He really was.
Right.
He was making a ton of money. He was buying land in different parts of Brazil. But then Brazil also had a economic downturn, and that kind
Got
of
it.
all caught up together. Those two secular trends, along with leveraging up at the wrong time, completely took him out of business and put him in a lot of debt at the time. And so we went through
Yeah.
3 to 4 or 5 years working that out, and and that was tough. We had to sell all the land that we had. We
Man,
had to sell all the house that we're building. We had to stop building and selling it. We had nice cars. We had to sell everything and go from there to driving the worst cars, and so and going from the best schools to the worst schools, and being a tennis player where it's a very rich kind of sport in Brazil, meaning
right.
only wealthy people play, and not being able to afford playing tennis anymore. So
Right.
going through all that, it was brutal, but certainly
Shit.
absolutely necessary. And now my dad is doing very well. I think I'm
Awesome.
doing just fine, and so I guess
Awesome.
the rest is history.
Man, I honestly, I think that's worse than like what I grew up with because
Oh,
I think, yeah, it's
I'm
the
sure you
reason
went
why I
through a lot
think
too.
that.
I did not mean to say what's
No,
worse
no,
than
no,
way, but
no, not
yeah.
not at all. It just for my mind, I was like really empathizing with that experience because I think the part to me that would make it so devastating is obviously your dad had risked so much even to get to that point, and then to have this huge unwinding essentially of all of it, like that to me is just that's devastating. So I mean, I
Yeah.
can't, I mean, and then your dad obviously just kind of bootstrapped it, right? Like he decided, like, okay, well, we got to make some changes here, and we'll get back together. And you said he's doing great now. So it's just that's a really inspirational cycle because that's tough. That's one of the biggest issues I think people have with taking risk is that they're scared of that, so they don't take the risk. But you have somebody like your dad that took the risk, got hit along the way, but able to turn out of it and kind of emerge. And like to me, that is the true focus of that story. That's incredible.
Yeah, I mean, they've always make sure I was in a good education in Brazil. I always had very good. I was always attending good places in terms of learning from different people, and that was always, I think, a key part of building up, this foundation to where we are today. However, yeah, it messes with you, especially psychologically. And
Right.
it's incredible that that my parents' marriage, went through all that, and
Yeah.
still they did really got together and things were fine. And so, but it was not
That's
easy.
so awesome.
It was
Yeah.
very challenging. And now it's like it's just like putting on a trade that you're taking on too much leverage, and then things don't go the way you expected, and where do you go from
Yeah.
here? So it's tough.
That's well, thank you for sharing, like sincerely, thank you for sharing that story. Because that is like that I've never personally thought about that cycle before. So that was actually kind of interesting to explore that a little bit with you. And it really is kind of motivating to hear, your dad was able to just face the risk, got hit by it, but then went past it. Like that's I think just really, really cool. Um, so then we fast forward and now you're at Crescat. You kind of started there, and talk to me about just what Crescat kind of is all about. You referenced more that as kind of a macro focus. Like I said, I had a chance to go through your SEC filings and stuff like that, but just for the elevator pitch version for everybody else, what are you guys all about?
Well, I guess learning lessons from what happened when I was younger, I think the biggest goal of the firm has been nailing and figuring out, identifying the big secular trends and being in front
Mm,
of them and really trying to capitalize from them as best as we can. And so we started from a macro perspective. We built models and different tools in order to help us to get to those views. We are also using a lot of value principles of value investing and really figuring out what are the best ways of expressing those views when it comes to what are the companies we should be purchasing and or selling short and so forth. So it's really a mix of global macro with value principles where we use proprietary tools in order to reach to those conclusions. And so we also bring expertise when we think it's time to be branching out and starting a whole new strategy. So precious metals is a great example. When 2018, we thought this was kind of the right time to be investing in precious metals, and we launched a new strategy, and that was the separate managed account of precious metals. And then later on, we launched a hedge fund, and this was where we bought a partnership with Quentin Henney, a geologist, to help us navigate the space. And so it's sort of no, we do a lot. I mean, it's it's like a question we get the most: how do you guys do it all? I mean, certainly starts from macro, and as it's great when you have very unbiased ways of validating your thesis. And so in a lot of ways, I think the precious metals and the commodities companies now all score really well in our quant models or fundamental equity models. And so, that is completely unbiased, and just happens to be the case that I also am very bullish on tangible assets and commodities as a whole. And so, a lot of so basically, I think was the idea was figuring out that the quant models that Kevin was building back in the days was leading him to macro views. And so we kind of swapped that
interesting.
and started using the macro models to then confirm those views along with the fundamental equity models, and that really helps. And so we're able to build a very diversified portfolio with a lot of big macro themes, and then we have sub themes within those big ideas. And our goal is to find out what are the best ways of expressing those, and that is an ongoing conversation on a daily basis.
Right.
And portfolio is always changing, so it's a lot of fun. But,
Yeah, yeah.
yeah.
So what are some of the like common products that you guys like to take a look at?
Okay, so large cap, it was when Kevin started. So we're one of the few funds that go back to the 90s. And so large cap is our long only strategy that was basically built by selecting companies, part of this fundamental equity model that scores the most liquid companies all over the globe. And we only buy the ones that score the best. And that rank change on a daily basis, and it helps us to manage risk. Okay, but that's one strategy. And then in
Got it.
2000, we launched the long short, and this was Kevin Smith at the time who was running this. The long short is very few long shorts go back to 2000. It was launched back then because he was very concerned about the equity markets, and he wanted to be flexible and able to short stocks at that time. And then in 2006, most of well, actually, the equity model was telling us that we should be short most of the home builders and some of the banks in the U.S. And so that, opportunistically speaking, he was like, well, I guess it's a maybe a great time to be launching a global macro fund that gives us even further flexibility to now purchase outside of equity only instruments. We can buy FX, we can buy commodities, and you can really express any of your macro views in any way you would like to. And so that was the beginning of the global macro in 2006, and absolutely nailed the housing bust. And then from there, it did other things such as the oil markets when things turned south, or when we had
Mm,
the commodities bull market in 2011 or 2010 and 2011, or we've had shorts in the Chinese markets back in 2015, 16. So a lot of themes that played out in our favor since then. And then 2018, given the fact that we're so bullish on precious metals, we decided to then launch a precious metals focused fund. And then by diving into that industry, we figure out as well, and we thought that the best way to be expressing that idea was to be buying what everyone else is not buying, which is exploration assets. And so the majority of the industry is really, most of the capital is being sucked into the big miners. And so, there's a lot of issues that we can get into from a macro perspective of why we think the exploration assets are going to be outperforming the entire industry. But that's really a macro trend that we think, will play it out in the following years when it comes to gold and silver prices moving higher and allowing those companies to do very well. So I think that gives you a sense of how we're basically positioned right now.
Yeah, definitely. And I think that's a great recap. I can tell that you're pretty familiar with running through that stuff because that's very polished. Um, so, a following question I have for you is you mentioned really, really briefly some of the exploration versus minor stuff, which we'll get into in just a minute. But I'm just generally curious when you're talking about all of these different funds, what kind of time frames do you all like to play in?
We have definitely a more of a long-term time frame. In fact, the precious metals fund and the global macro fund have a partial lockup for investors where they can put their money into the funds and they have 1 year lockup, full lockup. They cannot take their money out. After a year, they
Right.
can take 25%. After another
Got
year,
it.
they can take another 25%, and they can take the whole and the entire amount they invested initially. So we're looking for long-term investors. Our goal is to, especially this precious metals thesis where we're dealing with more illiquid assets. We have to have. It's not just the goal is not just to be big. It's to be big with the right type of capital, with the right
Right.
mentality and mindset. So, and that is the difficulty, is to find long-term investors that are willing to take that bet for the next 5 to 10 years.
Right.
And so it will depend. I would say the most of the big macro themes may take 3 to 5 years to play out, but there's a lot of sub themes within those ideas that may play out in 6 months to 12 months. And so I would say the turnover of the sub themes is much larger than the turnover of the big themes. So I think that gives you a sense of what we're
Yeah.
doing. If we get really, I guess, optimistic about that theme or a certain theme that we think will really play out in the following years. I think, the whole goal is to be flexible enough to launch a whole new strategy and bring expertise from outside to partner with us, and then hopefully, I think hopefully this will be a new business model for Crescat. So, we don't want to stop just in precious metals. We've been doing that with oil, but it's not a separate fund. It's part of global macro. And so
Right.
there's a lot more to do here, I think.
Right. So then just another kind of ground setting conversation. We obviously don't have to go super far into detail, but um, I'm curious to understand the quantitative models just a little bit more in terms of how they've been evolving over time. And I ask that question because I feel like we're going through different periods in the markets. And, we were talking a little bit about this before we started, just where things don't necessarily behave as we might expect them to. So I'm just curious about the evolution of the quantitative models to kind of cope with that.
Oh my goodness, it's been a crazy evolution. I mean, it as far as we've been building models to try to figure out the inflationary, what is the real
Mm,
inflation in the system, or especially where we are in the business cycle. I think the correlations change over time, and what is the right
right.
asset asset connection that you need in order to perform in this environment. So it's been a crazy evolution period, and I would say the fundamental equity model, it's a lot of back testing. It's a lot of back testing because the
Right.
majority of the quant indicators that have worked in the past most likely will not work in the future, and you have to kind of link your macro views along with the quant views. In other words,
Mm,
what are other times that the biggest challenge for quant strategists today is the fact that it's very, very difficult to find data going back to other macro regimes, such as inflationary regimes. And so if you're
right.
looking for company data from the 70s and 60s, good luck. There's very, very few companies that provide that to you. And so
Right.
the granularity of most of quant funds entering this macro regime change that we think we're in of inflationary environment is going to be challenging for them as well. So I have my guesses of what I think the factors that are going to be most useful in this setup, which I think it's going to be profitability. Companies with the cost of capital rising, you're going to have issues with large balance sheets. So companies are going to get squeezed by wages and salaries. So by using those models to search for what are the companies that can get most squeeze in a, let's say a company using free cash flow relative to the amount of employees, a very thin margin business that also have issues with cost of capital and more I guess more reflective of the cost of capital into their balance sheets and how much that can potentially squeeze their earnings. And so I think there's a lot of ways to twist this, and we're very open minded, but it's it's not easy. It does help quite a lot
Right.
to have models. We're building now models in regards to exploration assets and trying to figure out how do we reach the ultimate value of what is in the ground of a certain project. And so now empirically there are many ways you can do that, and so we've been seeking for different forms of when do we reach that peak valuation of an asset relative to what is in terms of minerals in the ground. And so the work in there is endless. I'm not trying to say it's impossible, but it's
Right.
there's certainly a lot of work to do, and curiosity will always drive your this process, I guess.
Yeah, and I mean it's a fair statement, and it's something I actually talk a lot about on the channel for anybody who's an active trader is back testing. And anybody who does it knows it's you even getting the data is expensive, and once you have it, it can be really time consuming to parse through. So, yeah, I can only imagine what you guys, especially the level of detail I'm sure you go into, trying to get that information. It's got to be such a pain in the ass. I do not envy you.
It's
Um,
fun if you like to have a view. I think it's important to dive in. I
yeah.
think the best ideas come from those real analytical moments in our quant models, and so I think it's very important.
Yeah, and I think that there's also something to be said about a lot of traders who've been around for a while, start to come across this phenomenon where you know, the markets are ever evolving, but there's a lot of things that repeat themselves over and over and over again across the market. So taking the time to kind of review some of the, past cycles and how the markets have reacted to that, to what we're seeing now, I think there's a lot of value in that, which kind of flows into my next question. Yeah, sure. So, kind of in the context of previous market behavior, not necessarily dictating, but potentially informing future market behavior, especially during unprecedented times, at least in recent history, where we're at 7.5% inflation. Just, I'm curious your perspective on kind of a broad level market overview of where the markets are at today and just your general thoughts on what they look like throughout the rest of the year.
Hmm. I think it's important to go back and understand what is happening with the U.S. especially. I think it's the first time in history that I know of, at least 120 years of history, that we're facing three macro imbalances all at once. It's a
Mm,
debt to GDP problem that we had back in the 40s. It's the inflationary environment that we had in the 70s, but it's also the speculative environment that we had in the late 90s. And those three issues are certainly not only explosive in their own, but they also create a lot of political constraints in regards to what the Federal Reserve could do in order to keep a lead on inflation at the same time as not allowing cost of capital to rise. And so we're
got
not
it.
able to to have interest rates rising too much. Otherwise, you cannot justify the excessive valuations in risky assets, along with the leverage in the system. But at the same time, you've got an inflation problem where copper, oil, agricultural commodities could not care less if interest rates are at 2 or 3% in terms of the Fed funds rate. And so we're seeing, on top of that, a chronic period of underinvestments in natural resources that have created a lot of imbalances when it comes to supply constraints that cannot be fixed in the short term. So I think what we're seeing today is one of the most bullish environments for owning tangible assets that we've seen in history. And so, what are the big themes here? So, I think one of the big themes is inflation is here to stay, number one. Number two is, if that's right, then you got to be careful with what is the leadership of the market going to look like when it comes to where most of capital allocators have parked their money into, which is long duration assets. What does that mean? It's mostly technology related companies along with fixed income. And so we've
Yep.
seen most capital allocators putting money into technology, and in order to hedge that risk, they bought also a lot of treasuries and other fixed income like um, uh, junk bonds and investment grade bonds and so forth. And so most of the portfolios in the world kind of look like that: technology and bonds. And I'm pretty sure what's going to happen in the future here, or I would say at least my view is that this macro puzzle is going to cause a shift of capital allocation into things that don't have such a long duration, meaning things that actually make money today, like
Right.
natural resource industries, where profitability is going to come back, where capital is going to be chasing um, businesses that actually make a lot of money and don't have a lot of debt. And so, natural resource industries is one of the places where I think most of that capital is going to chase. Um, and it's going to be coming out of the growth stocks. And so, you're going to see very likely the continuation of a out of growth stocks into value companies, kind of like what we saw back in 2021, where oil and gas companies, EMPs, exploration and production companies, had their best year in 30 years. And so it's going to be a continuation of that pattern, I think. And you can add the geopolitical problem with inflation, which is the deglobalization patterns that we're seeing, that I think will continue to press on this inflationary pressure in the system. And so, um, I don't think this is a buy the dip environment in equity markets. I think this
Mm.
is a leadership change, and with technology being almost 40% of the S&P 500, if I'm calling for outflows of technology and inflows to, let's call it energy, at 3.8% of weight of the S&P 500, you don't even want me to get started on what's gold weight or gold miners weight in the S&P. There's only one of them, Newmont. And so
Right.
you start thinking about this, right? I mean, global equity markets at $120 trillion today. If you look at natural resource industries at about $10 trillion, if you take out energy, it's only $3 trillion. And so there is a mismatch here that I think will create an incredible opportunity for investors as money flows into those less of, I would say, natural resources, but also more profitable business models that have been, that I think are very unloved, especially in the last 5 to 10 years, and are now in this beginning of a move here. So, obviously that is all linked to the underlying tangible asset of each of those businesses. Oil companies linked to the oil prices, and so is gold miners with gold. And so I think we're at the beginning of this outperformance of commodities relative to overall equities that are extremely expensive. And so, it's buying cheap and selling expensive. I think that will continue to work. And so, There's, it's too many. I think there's a lot of ways to play this, but we think that uh, I gave you some examples already. I think agricultural commodities look very attractive. I think there's a risk for a food crisis. This is the first time we're seeing food and energy prices rising at the same time, and it's almost like the 70s on steroids. And so
Right.
a very interesting environment, and central banks have zero control over this. So
Right.
um, it's not the end of the world. I mean, there's a lot of very
Sure.
opportunistic themes to capitalize on. And I think, there's a lot of ways to do it.
Yeah. Speaking of that, can you talk to me a little bit about your thought process on like the gold exploration versus, just physical gold or even the miners, for example?
Well, I think there's a lot of things to unpack there. First of all, the industry you know, is is just left for dead, meaning it's, majority of capital has been chasing the major companies. And so there's about $550 billion of aggregate market cap for public companies in the gold and silver space. And what you find here is that companies have been under investing in exploration because of the fact that they have been called, they've been bleeding capital for many, many decades and lost money
Right.
and never made any money. And finally, because of that conservatism coming from management, we're now seeing this shift towards, really becoming more profitable. And certainly that is shown in most of the profitability measurements that you can look at, such as median free cash flow yield or aggregate free cash flow yield for the overall industry, and which are some of the best ones we've seen in history. So there is an accumulation of cash balance and position from most of the majors at a time when they've been depleting their reserves in order to generate free cash flow by producing more. And so the lack of exploration and using less and less of an exploration budget, and I mean, just think about when was the last time we've seen any of the majors build a whole new project in precious metals or
Right.
base metals? I mean, we haven't seen any. And so all those issues are creating a setup where companies are going to have to be looking for exploration assets in the future. Um, and
Quick question. Oh, sorry, go
yeah,
ahead.
no, no, go ahead.
Just a quick question on that. Like, if we're looking out 10 years, do you think gold is more or less valuable in 10 years from now?
I think it's will be a lot more valuable. The whole reason why you want to be, in my opinion, investing in smaller micro cap stocks today in the gold space is what is the risk of gold being at lower prices 10 years from now? Given the reckless amount of fiscal and monetary stimulus worldwide and the imbalances and the constraints that we have in a place where we do have this debt valuation and inflation problem, where do we go from here? So I think it's going to be very difficult to fight inflationary problems. We're going to have to run inflation rates much higher than we saw in the last 30 years with financially repressed environment of trying to suppress interest rates as much as we can at the same time. And so this, in my view, will create kind of a supercharged environment for commodities. It's very bullish. And so I think if you are of the view that gold and silver will be more valuable, if you start with gold and think about what's happening with the crypto market, just not to digress, but it's all
Yeah,
linked.
no, I'm actually curious about that. Yeah.
Yeah, so it's all linked. The crypto market and the community of crypto in general is started with a libertarian movement, more, probably the
Right.
biggest we've seen in history. I don't remember any other one that was as popular as the crypto market, where people were basically saying, look, I mean, fiat currencies have zero value. And I'm saying mostly from the Bitcoin community that likes to say that there's no anchor to the dollar, there's no anchor to euro or Brazilian real or the Chinese yuan. And so what is causing here is the lack of credibility from central banks, where think about this. I mean, most of the central banks in the world, the ones that have the best credibilities out there, are the ones that hold treasuries of the US treasuries. In other words,
Right.
they basically own debt.
Right.
We've went so far on going out of the gold standard to now giving credibility to economies that buy debt from another indebted economy. And so, at what point do we see such a libertarian movement, which I think already, we already crossed the Rubicon in terms of that, is starting to pressure central banks to improve the quality of their international reserves? A currency is anchored by the quality of their international reserves, where today international reserves, the majority of that is mostly on US treasuries and other treasuries of other developed economies. And so, at what point do we see central banks are starting to buy gold, right? So, I think historically, I don't think central banks will be buying Bitcoin personally. I think Bitcoin has its own uses and demand that will
Sure.
continue to drive it higher. But central banks probably will buy, at least in the next 5 to 10 years, maybe in 30 years, we'll be buying Bitcoin or some other crypto asset. But I think
Right.
in 5 to 10 years, we'll see gold playing that role again. And if you think that that's going to be the case, that is really what drives gold, let's say 20, 30, 40, 50% higher. If you are of that view, then what do you think silver is going to be worth? And so you start extrapolating that domino effect of gold moving higher. And what are the most levered ways to be long that commodity or that currency, whatever you want to call
Right.
it? So that's where it started. This whole thing is the imbalances drive, and this movement drives the need for a credibility improvement from central banks that will drive assets of things like gold, silver, and other commodities significantly higher from here at a time when any central bank needs to suppress rates and allow inflation rates to run hotter than other times historically. And so I think, there are different ways to play this. You can buy the big miners. That's they have consistently shown that they can produce in a certain level, and also perhaps even have very consistent free cash flow
Right.
profiles for many decades, in depending on the company. Um, the issue with this is that we're also seeing a rise of energy prices and a rise of wages and salaries, where it's going to also squeeze the miners. There's no way around this. And so, in my view, I think that you want to own minerals that are in the ground. Minerals in the ground have a levered way, not in the sense of debt, but in the sense of leverage to the price. And so I think this is the best way of, empirically as well, it's been the best way of playing the bull market for gold and silver. So that is basically what we're doing at a time when, more than any other time in history, we've seen this chronic underinvestments from the majors onto exploration assets. And so I think, this industry and the exploration side is tiny, tiny. And so, smart capital is capable of entering that market and buying large portions of those businesses, large stakes up to 20%, and own the best high quality projects in the world that can perhaps be purchased by those big miners in the future.
Right, right. Yeah, that makes a lot of sense, and it's interesting to hear your perspective. I actually echo a lot of that. Just I was curious how you were fitting it in terms of the role of gold short term and long term, because I personally do question even the value of gold in 30 years, because for a long time, we were using it in manufacturing for a lot of different components, obviously super precious, but everything is changing, especially as you noted, in terms of how most countries are starting to value their currencies and back their currencies. I mean, look at China with this whole business going on with Ukraine being invaded by Russia. China is sitting there saying, like, hey, let's find a good solution here, because China is holding a ton of our debt.
Yeah.
So I can't imagine, that any sort of significant escalation in the war will benefit them at all, which leads me to my next question, which is, we have about less than 10 minutes left. So there's two big questions I want to ask you. The first one is, talk to me a little bit about your perspective on Russia invading Ukraine as it pertains to impacting just the economy, both in the US and globally.
Oh, well, I think first and foremost, just looking at, I mean, you come from the military environment, that spending in that space has been declining and a declining rate for many, many decades. It's been in a secular decline all the
Yep.
way back to the 60s, which is, like it or not like it, I think when we have geopolitical tensions, one of the outcomes out of there is that increase in spending and fiscal and military spending. And it's important to know that we're going to probably see that, in my view, in developed economies. This is happening across the world. Germany now just announced they're going to be increasing their military budget by about $100 billion, 2% of GDP,
Right.
which is the minimum to being part of NATO and so forth. And so we're probably going to see this across the board. But what does that mean to increase your military spending when you also have fiscal spending already at the levels that we have? And I think this is inevitable. It's what we're going to probably see is the fiscal imbalance getting worse, and the fiscal agenda has never been so extensive. You got peak inequality happening at the same time
Right.
as you have geopolitical issues. You have the green revolution. You have this infrastructure developments and need in the US. And so all that is going to feed into also the military spending, with the fiscal being big relative to the GDP, where it's going to need further financing from someone to be financing and purchasing the US debt. And after what we've seen so far with Russia in Ukraine, I think it's going to be more and more difficult for us to be uh, funding things in general. And so it's going to
Mm.
create a role for the central banks of the world to start financing some of those operations, which just means monetary dilution in general. And so ultimately, I think we're going to go there. I think this is a big shift, geopolitically speaking, and showing how strategic commodities have become in just the course of 3 to 4 months. And we've seen this
Right.
throughout history in the past, but now more than any other time, oil is such a strategic asset today to have,
Yep.
and food. Whoever country that owns enough agricultural commodities and oil and other even copper and some other other things, other minerals that will play into a bigger role in the future, I think are going to be in good hands. And so you have to think about China, India, that are not in that position relative to a place like Brazil, for instance, and maybe even the U.S. and Canada. And so I think there's going to be a lot of changes in terms of fiscally what we're going to see here. I think there's no way around this. I have no idea what Russia is going to do, but it is questionable how much more dangerous the leadership of Russia becomes when you have one of the perhaps the most embarrassing moment for Russia of Putin's career. I think. I mean, it's been a total
Yeah.
failure so far what he has done. So, in my opinion, and so
Sure.
what is he going to do now to restore the credibility inside of Russia and into the rest of the world with a message that he wanted to send, but unfortunately that message didn't come across yet. And so it's a little scary in that sense.
Yeah.
I hope we're not going to see a world that a lot of people think we will see, but the best that I can do as an investor is to continue to buy and take advantage of that volatility that we're seeing. I think rallies needs to be sold, not buying the dip is a strategy that I'm not sure will work the same manner it happened in the past. And I think there are places that are uninvestable. I've always thought that. I mean, it's giving you another idea of how principles are important. And even though China is cheap, we do not invest in Chinese assets. I mean, we can only Crescat only shorts China if makes sense. And so we are not long China and we're not long Russia. I don't care how cheap it is.
Right.
It's just not, not part of our moral views in general. And so I think, we don't finance communism across the globe. I'm sorry to get there, but it's just not what we do. And so we don't invest in Russia. We don't invest in China. We invest in other places in the world that we think could potentially do well. And if they ever start to become like Russia and China, we'll exit from those places too. And so I think strategically we got to think about China and Taiwan. I think there's
Mm,
quite a lot of books about the situation with Taiwan. I
yes.
think certainly has opened the path for such a potential invasion
Yep.
or a takeover of Taiwan. I think the best way to do that is, since we started those issues with Ukraine, we have not seen the changes in FX in the Chinese market just yet. And so, meaning the Chinese currency has been very stable so far. We added short positions in the Chinese currency. We've been short the Chinese currency for many years, and sometimes it works, sometimes it doesn't work. And but we think it's one of the most overvalued assets in the world today, and it is a major imbalance when it comes to banking assets relative to GDP. I have a very different view than most people that think China and Russia are playing the long term game. I actually don't. I'm sure they are, but I think Russia has been a total failure. I mean, just look at the currency and just look at the China the Russian market in general. I mean, it's been a total failure.
Yeah.
So
Well, the ruble dropped like 20% or something overnight when all the
yeah, I mean,
sanctions started coming through.
what type of long term game is that? I mean, that's
Right.
been the worst performer in one of the worst performing countries in the world, I think. And so have Chinese equities too. And so I don't know. I have a very different view. I find it difficult to see large capital allocators going into China, especially in the next 5 to 10 years, given all that's happening. And so you have to question what is going to drive those economies to continue to perform very well. In an environment where commodity prices are rising, where is China going to keep up growing at 10, whatever they number that they tell you that they're growing at 10% rate every year, when oil prices in Chinese yuan terms is at the most expensive it has been in like 7 years or so. And so, I think it's all questionable. Current accounts are going to become more on the deficit side for China relative to the rest of the globe. That is all very negative for China, not positive. India is in the same spot, by the way. And so I much rather belong Brazil than belong China, by the way. So there's a lot of macro developments here unfolding at the same time. But hopefully, I shared some of my views.
Oh, it's awesome. I literally love hearing just these kind of conversations and how other people view what's going on today and where the opportunities lie. Because yeah, I mean, what oil hit 107 today?
Yeah.
It's just there's a lot of things making moves that are just very fascinating to me. So thank you very much for sharing your perspective on it. We are at time, so I promised you I'd get you out the door, so I will honor that. However, before we sign off, I do need to say, because I didn't say it yet, I love your beard. I need to compliment the beards that I see, support the beard movement. So just very nice.
It's not like yours,
And
but
it is beautiful. Beards come in all different shapes and sizes, and I'm a big fan. Um, so yeah, thank you so much for your time. I know people, they can find you on Twitter just like I did, which is at Tavi Costa,
yep.
which I'll also throw in the video description for people that want to just follow along. You share a lot of great information, I think, so it'd be cool for people that are interested in following along. So thanks again for coming to hang out for a bit. Really had a great time.
Hey, thank you, Eric, and thanks for serving in the military. Being a Brazilian, and I also appreciate that quite a lot. So thanks for doing that.
My pleasure. Yeah, it's awesome. Thank you. Perfect. Yeah, that was super fun.
Yeah, hopefully you enjoy that. Yeah,